some of the burning questions regarding selection of tax regimes. And finally, we are going to look upon the tax saving avenues available for you under each of the regimes. And finally, we are going to have a doubt clearing session. If you have any doubts, if you have any queries, we are going to answer those at the end of the session. I am CA Shoikotra. I've been working with Clear Tax for the last 3 years. My area of expertise is income taxes and international taxes. So, without further ado, let's dive into the today's session. First of all, we are going to look what are the recent changes that has been made under the budget. First and foremost, we are going to talk about the changes, the amendment that has impact upon the individual taxpayers. We are not going to go into detailed analysis of all the recent changes and amendments that actually impacts the corporate sector, right? So, moving on, the first big change that has been made in budget 2021 is the ULIPs, the unit linked insurance policies that has been brought under the ambit of taxes. Previously, whenever you have received the insurance proceeds at its time of its maturity, provided it fulfills certain criteria, it was completely exempted in your hands. Now, what is that criteria? If the premium paid was not exceeding 10% of the sum assured, then the maturity proceeds were exempted in your hands. However, in this budget, if you have taken a new ULIP policy starting from 1st of February 2021, where you are paying a premium of 2,50,000 rupees or more annually, the entire proceeds at its maturity will become taxable in your hand. Now, here is a clarification that if you have taken the ULIP policy before 1st of February 2021, this does not fall within the ambit of this taxability. If, however, you have taken the policy on or after 1st of February 2021, the sum will become taxable in your hand. The premium should not be more than 2,50,000 rupees in any of the year. Now, here is another question, that whether the ULIP policy can be taken for the ULIP policies for one ULIP policy, the amount is 2,50,000, more than 2,50,000 rupees, or all the ULIP policy I have taken on or after 1st of February 2021 more than 2,50,000 rupees. What will be the criteria for determining 2,50,000 rupees or more? To this, all the ULIP policies taken together, we need to see the limit of 2,50,000 rupees or not. So, for one premium, for one ULIP policy, you have paid a premium of, let's say, 1,30,000 rupees. For another one, you are paying 1 lakh rupees. So, in total, you are paying 2,30,000 rupees of premium. So, in that case, these will not be taken together. This will not be considered together. However, if you have taken one ULIP policy wherein you are paying a premium of 1,30,000 rupees, another you have taken and you are paying a premium of 1,40,000 rupees, taken together the premium paid will be 2,70,000 rupees, and in that case your total premium payment towards ULIP policy is crossing the threshold limit of 2,50,000 rupees, and you need to think about the taxability when it becomes mature, right? Now, that said, another question arises: how they will be taxed in my hand? To this, the similar treatment that we give to uh, mutual funds, equity mutual funds, the similar treatment will be applicable for this ULIP policies. Moving on, uh, the LTC, that is leave travel allowance or leave travel concession. Now, at the time, uh, it was this exemption was presented so that if you are making a travel during a block of 4 calendar years, any to and fro traveling expenditure could be deducted from your taxable salary. However, in the wake of COVID-19 pandemic, traveling became very much impossible. To alleviate this situation, because you will not be able to travel and you will not be able to exercise this LTC exemption in your taxable income, to alleviate this situation, the Income Tax Department has introduced, or rather, introduced this section, this scheme, wherein instead of traveling, if you are purchasing certain items or if you are paying for certain services, the amount paid for that services or the amount you paid for those goods will become a exempted income in your hand. All right. So some trouble with the volumes. Hello, is it good now? Okay. Right. I will try to raise my volume a little bit. Hopefully that will resolve the issue of the volume. Now, uh, regarding this LTC cash scheme, scheme, if you are not able to travel, then if you have purchased certain items during the time period, that is 12th of October till 31st of March 2021, at that time period, whatever items you have purchased on which you have paid a GST of 12% or more, that amount can be exempted in your hands. Now, how this will work? First of all, we have to see what is the LTC component in your salary, right? After doing that, we have to see what is the price you have paid for the entire items. Say, for example, you have purchased an AC, right? And for that you have paid, let's say, 36,000 rupees, right? And on that, there is a GST of 18%. So all in all, you have paid 36,000 rupees, which is inclusive of GST 18%. Now, the law says, or rather the rule says, whatever amount you have paid, one third of that amount or 36,000 rupees, whichever is lower, will be given to you as exemption subject to the LTA component of your salary. Now let's break it down. In your salary, let's say there is a LTA component of 24,000 rupees, right? Every month you are getting 2,000 rupees as your LTA component. For 12 months you are getting 24,000 rupees. Fine. Your AC purchase is 36,000 rupees. One third of that will give us 12,000 rupees, right? and the maximum monetary limit for this is 36,000 rupees. Now we have to see what is the minimum between 12,000 rupees, that is one third of AC purchase cost, and 36,000 rupees, that is the maximum monetary limit, right? So the amount becomes 12,000 rupees. Now we have to compare this 12,000 rupees with your LTA component that is already embedded in your salary, that is 24,000 rupees. Lesser of these two will become your exemption, right? And lesser of these two is 12,000 rupees, and 12,000 rupees in this case will be exempted in your hands, right? So this is how the LTA cash scheme works. Furthermore, LTA cash scheme is also allowed to your family members as well. So if your family member if you have a family member of 2 or 3 or 4, whatever, who are dependent upon you, the LTA cash scheme can be increased to that context, right? However, you have to check what is your LTA component in your salary so that you can take the maximum benefit in your tax return. Moving on, the PF. Now, till the budget 2020, whatever amount you are accumulating in your PF, any interest earned on that became exempted in your hands. However, many high earning people were taking this advantage and they were making a huge investment in PF, be it EPF, be it annuity schemes or NPS scheme, whatever may be the situation. However, going forward, there has been a maximum limit prescribed for PF, right? So basically, if you are making a contribution more than 2.5 lakhs in a year into your PF account, any interest earned on that, that is in excess of 2,50,000 rupees, any interest earned on that will become taxable in your hand as part of your salary. So how this will happen? Let's say you are contributing towards PF 3 lakh rupees, right? So there is an excess contribution of 50,000 rupees, and on that 50,000 rupees, let's say 10% is the interest rate. You are earning an interest of 10%, right? So on 50,000 rupees, you will be earning 5,000 rupees as PF interest, and that 5,000 rupees will be added to your taxable income, and it will be taxed accordingly, right? Any question related to PF or LT or something like that, please make a note of it. I am going to address all these questions at the end of the session. So apart from bringing up many new incomes, many new incomes under the ambit of taxes, some good news has been introduced for senior citizen people. So any senior citizen person who are more than 75 years old and they are earning their income by way of pension and interest from one singular bank account or one singular bank branch, that person need not file any income tax return, provided the bank is deducting taxes and paying the taxes to the income tax department, right? So if this is the situation, then certainly this may not be applicable for you per se, but this may be applicable for your parents or your uncles, all those senior citizen persons who are related. Excuse me. However, to get this thing, to get this exemption, you must deposit a declaration to the bank so that they can compute the taxes and deposit the tax amount to the government. And one of the most important thing that is coming up, that is the revision of filing the due date in respect of income tax returns. Now, as we all know, the normal due date of filing the tax return is 31st of July of each assessment year. And sometimes, if people are facing genuine hardship, CBDT, the Income Tax Department, they usually extend the time limit by 1 month, 2 months, 3 months. In 2020, the due date has been extended till 10th of January. The belated return due date was 31st of March, every assessment year. However, in this budget, this due date has been cut short, right? So basically, if you are filing a belated tax return or if you are filing a revised tax return, you could have filed those two within 31st of March of each assessment year. However, this time limit has been cut short to 31st of December of each assessment year, right? So if you are filing your tax return belatedly and if you are under the impression that yes, I have time till 31st of March of the assessment year, that is about to change because you have less time in your hand for the filing of belated tax return or revised tax return. So going forward, please take this thing as seriously as possible because after 31st of January, for 31st of December, it will not be possible to file your belated tax return or revised tax return for that matter. And if you miss out on declaring certain incomes, then you may have to go through a rigorous route of asking condonation of delay from the assessing officer, getting that approval and filing the tax return on the basis of that order. So going forward, please be careful regarding this. Okay, in this case, here I can see one very interesting question in respect of LTA. I'm going to take a couple of minutes now and answer some of the question. So, Shantanu actually is asking if we have received LTA as taxable and we have not claimed LTA in 2021 through employer, then how will it be happening? Well, in this case, you have the option to claim this thing in your tax return. If you have not claimed it through your employer, you will be having this option to claim this at the time you are filing your tax return. However, the computation have to be according to the rule. You have to check 1/3 of the expenses, actual amount of 36,000 rupees per person, and the maximum limit provided by your employer. Comparing these three, whichever is the least amount you can claim as exemption in your tax return. Generally, LTA can be claimed through employer only. However, going forward, this is a special case and the rule came in after the year ended, after the declaration window closed. It can be claimed at the time of you filing the tax return. So, if you indeed made the eligible purchase within 12th of October to 31st of March, you can claim it. Right. Now, let's have an understanding of new tax regime. Now, this tax regime, the new tax regime has been introduced in Budget 2020 by our Finance Minister, Ms. Sitaraman, wherein she mentioned that under new tax regime, there will be a lot more tax slabs and lot lesser, smaller tax rates. Okay? As compared to the older tax regime, where the slabs are quite spaced out and tax rates are quite high. This can give some people joy, or rather many people joy, that yes, my income is spaced out in a very broad spectrum, and there are lot smaller amount of tax rate attached to each tax slab. However, I would not be happy if I was in your place, I would not be as happy as you are, because the tax rate, even though are lower and income slabs are even though spaced, a lot of the exemptions, lot of the deductions has been taken out of your hand, right? So under new tax regime, the purpose was to make tax return filing process as less cumbersome as possible, as less rigorous as possible. So by giving you the higher margin or a higher spectrum, they have taken the ability of yours to claim deductions and exemption from your salary. So if you are going with the new tax regime, all the usual exemptions are completely unavailable for you. If you are paying a rent for your employment purposes, you cannot claim that. You cannot claim HR. If you have plans to claim LTV, you cannot claim that. If there is a standard deduction of 50,000 rupees, if you see your form 16, you can see under old tax regime there is a standard deduction of 50,000 rupees. That is not available for you. If you have taken a home loan and paying the home loan interest, that is not available for you. If you are making PPF deposits or life insurance premium yearly basis or medical insurance premium yearly basis, none of those things are available to you under new tax regime. However, those are still available for you if you go with old tax regime. Now, here it is, you might be asking yourself the question, at the beginning of the year I have switched to new tax regime. However, I do have these expenses, I do have these deductions available for me. So what will happen? Even though if you have selected new tax regime at the beginning of the year, you can switch back to old tax regime at the time of you filing the tax return. The only problem in this switching is once you make the selection under new tax regime or old tax regime, any of it at the beginning of the year, you cannot switch it back to other one during the year. So if you select one option, it will be locked down for you the entirety of the year. However, you will still be having the option to file the tax return as per the other tax regime. But every month or every quarter, a higher amount of taxes will be deducted just because you have selected one tax regime over the another. Now, here you may have this question that how the tax computation can be done, or how am I supposed to make this decision, which tax regime is beneficial for me. Now, in this case, I would strongly recommend to use a calculator that has been developed by ClearTax, wherein you can put the figures as per your last year's Form 16. You can put the amounts over there and see for yourself, right? Because until and unless you are putting the data which are applicable to you, whatever example I am going to give you, that might not go down too well with you. So use the tax calculator which is available at ClearTax portal. Nitisha and Nupur are going to share the link with you pretty soon, and use that link, put in the figures as per your last Form 16, see the result for yourself and make an informed decision. However, to give you a small context, I'll just give you one small example. So if your salary is at 10 lakh rupees limit, if your salary is at 10 lakh rupees of limit, if you are able to claim 1,87,500 rupees of deduction, then both of the regimes are same for you. If your deduction is higher than that, old tax regime is beneficial for you. If your deduction is lesser than that, new tax regime is beneficial for you. Now, out of 1,87,500, 50,000 is taken care of by your standard deduction. Remaining 1,37,000 rupees that can come either through your HR exemption, it can come through your PF, it can come through your LIC premiums, medical insurances, home loan interest, all these things combined together. But without just giving you these dry numbers, I strongly recommend to use a calculator yourself and see the figures so that you can make a decision. While talking about the taxes and incomes, one question pops up every Mayadi's mind, that how can I reduce my tax burden, and how can I increase my tax take home salary tax. Now, to this, I would strongly suggest that you look to some tax saving instrument, tax saving equipment, and consider investing in this. Some of them are a bit risky, some of them are less risky, some of them are not does not require you investing any additional sum of money. Some of them are expenses that you do day-to-day basis but don't know they are actually tax saving expenses. Now, all those things we are going to have a discussion a few minutes later on. But I would strongly recommend, before making any tax saving instrument or before considering all the deductions to your employer at any point of time, consider the points that we are going to discuss in some time, so that you can take a stock of all the expenses, all the deductions you are making, and claim that in your tax return, so that your employer can take a note of that and make the tax calculation and deduct taxes accordingly. Right? Along with that, I would like to say a couple of things about tax saving instrument. That is, some of the tax saving instrument has the dual purpose. Not all the tax saving instruments are singly focused to give you tax saving benefit. Some of them are designed in such a way they can give you the benefit of tax saving. Along with that, they can give you the benefit of building up your wealth. One of such instrument is your ELSS. Now, ELSS primarily is a mutual fund. So, the benefit of equity mutual funds are attached to, right? So, if you are investing in mutual funds, what do you expect? That after a long period of time, let's say after a period of 8 years or 10 years, you are able to make a hefty sum of return. Yearly, on an average, 10% or 12% of return of whatever amount you are investing, right? So, those benefits are actually available for ELSS. However, if you want to play safe, if you really want to play safe, then there are also a tax saving instrument available for you. That is tax saving PFs. In those tax saving PF, the rate of return is around 6 to 7% in a year. You will be getting that return, and the risk is much lesser as compared to ELSS, because that tax saving FDs does not depend upon the market. It actually is backed by the banks, and you can get a moderate amount of return if you go with tax saving FDs. Now, we can have an understanding of tax saving deductions and tax saving instrument. Now we can have an understanding of the tax saving planning, the tax saving strategy. Usually there are two types of tax saving strategy. One is your long term and one is your short term. Right. So long term tax savings long-term tax saving actually involves you investing the money into your ELSS. Why? Because ELSS does have a wealth building mechanism embedded into it, right? So let's say from this point onwards, you consider saving the taxes and you start investing in ELSS under SIP, and you will be getting the tax benefit for that in your tax return, obviously. And after 10 years, you will get a hefty sum of money in return because you have gone with SIPs, right? For the short-term income tax planning, you can park the amount into some other tax saving instruments, say for example the tax saving FDs, or you can take advantage of tax saving expenses such as tuition fee for your children, or if you have purchased a house property, the registration fees paid for that house property. So all these things combined, you can come up with a tax saving plan. You need not go for a longer tax saving period strategy or a short term. Just take a look at what are the expenses, what are the deductions you already incurred during the year, and based on that, strategize accordingly. You can actually have an understanding that what are the tax saving expenses, because many of times we spend the money and we don't know we can take advantages of that at the time of filing the tax return. For example, like I mentioned, your children's tuition fees. If your children is going to school and you are paying the fees for that, you can take the advantage of that. These are tax saving expenses and you can claim it in your tax return, right? So you can certainly save the taxes in that way. Also, one of the key thing is do not invest just to save the taxes. Strike a balance between saving the taxes and building up your wealth. Just because you want to save the taxes, you start investing in ELSS. However, there are a couple of other funds that are giving you a strong return. After 5 years or after 6 years, you are going to have a return of let's say 20% or 25%. But you are so hell-bent on saving the taxes, you completely ignore that and you keep on investing in ELSS even though the return is lesser than that of the normal mutual funds. So just don't go by to save the taxes. Saving the taxes and building of your wealth should go hand in hand. Just keep these small things in your mind and you will be good to go. Now, we are going to have a look what are the tax saving instruments that are available to you. The tax saving benefit, the tax saving deductions are categorized in many ways. Some of them come under 80C, some of them come under 80D of Income Tax Act, some of them come under 80U, 80EE, 80G. There are lot of sections under which you can claim the deductions. We are going to have a little understanding of each of the sections and we are going to have a discussion how this can be claimed in your tax return. First and foremost, your EPF. Every month your employer deducts a certain amount from your salary and deposit the money in your name into PF account. Now, this is automatically comes in your Form 16. For this, you need not submit any additional document to your employer, and this will be part of your Form 16 going forward, and this can be claimed under 80C. Second is your children's tuition fees, children's education fee. If your children is attending school, then any amount you pay to for education of the children, that can be claimed in your tax return. Now, here lies a question. Is it the education fees? Does it only include the school fees or does it include any coaching fees, any tuition fees or any sports fees as well, because many of the students take, let's say, cricketing lessons or football lessons or swimming lessons, dancing or singing lessons. To this, uh, only the education fee, whatever amount you pay as a part of education, that is exempted. Now, the education means any amount you are paying to a school registered under the education board, that becomes exempted in your hand. Usually, only the schools are registered under the education boards. So, any amount you pay for the school will become exempted in your hand, or rather deductible in your hand, not the tuition fees or coaching fees or the cricketing fees or football or dancing or singing lesson fees. Moving on, life insurance premium. If you are paying a life insurance premium for yourself or your dependent, that amount can be claimed in your tax return. Now, the policy has to be issued by any insurance service provider who is under IRDA. However, most of the large, or rather all of the large insurance service providers are registered under IRDA, so you don't really have to worry about it. The amount can be claimed in the year of payment, and here is an interesting information. Sometimes the insurance companies charge GST on the premium. Right. Now, the question arises whether the amount of GST should be claimed as deduction or only the premium amount exclusive of GST. To this, the CBDT has cleared, or rather issued a circular wherein it says that if your insurance premium includes a GST component, that premium plus GST both are to be considered for 80C deduction. So GST paid on plus premium both should be deductible from your salary, from your taxability. Moving on, principal on home loan. So many of us are having this dream of owning a house. And for that, we take home loan. Now, if I am taking a home loan, there are two components of that EMI. One is your principal component, another is your interest component. The interest component in case of a self-occupied house property, that means the property in which you are living, or in case you are not living, your parents are living and you are located to some other city for your work purposes, for that house in which your parents are living, you can claim the interest amount, provided the interest is not crossing 2 lakh rupees. The amount can exceed 2 lakh rupees, no problem, but the deduction will be limited to 2 lakh rupees only. Right? That is in case of self-occupied house. If it is not clear, let's give you an example. Say, for example, you are actually a resident of Delhi. However, for your work, you shifted to Bangalore. In Delhi, though, your parents are staying, and for them, you have purchased a flat, and for which you are paying a EMI of 4 lakh rupees, out of which 2,50,000 rupees is the interest component. Now, this 2,50,000 rupees is your interest component, and that can be claimed up to 2 lakh rupees in your tax return, and that will be claimed as deduction under section 24B. And since you are living in Bangalore for your employment purpose and you have taken a flat in rent in there as well, you can claim HRA in your salary as well. So herein there are two questions, or rather one important question is answered, that if I have a home loan and along with that I am paying a rent, can I claim HRA and can I claim interest on house? Yes, you can. Short answer is yes, you can, provided both are located in two different cities. If that's the condition, then certainly you can take both the benefits. Now, interest component can be claimed under 24B, section 24B. The principal component can be claimed under 80C. What are the other tax saving instruments available? Uh, if you have taken a pension plan, for that you can claim the premium component, right? So if you have taken a pension plan and for which you are paying a premium each year, that amount can be claimed in your tax return. The pension plan can come from LIC or any other service provider, any other insurance service provider. You can claim it, and the amount can be claimed under ATC. Here is a very interesting tax saving component available for you if you are investing in NPS, that is National Pension Scheme. Now, NPS, that is prescribed under Section 80 CCD. There are three facets of this deduction. Number one is a portion. Originally, if you are making an investment in NPS, it can be claimed under ATC. However, if your ATC limit is already filled up, that is, you have already invested in ATC, yet you are investing in NPS, for this you can avail another additional 50,000 rupees in your tax return as deduction. Now let's try to understand this scenario with an example. Let's say during the year, your EPF is coming to 30,000 rupees. Employer Provident Fund contribution is coming to 30,000 rupees. You have taken a home loan for which you are paying a premium of 1 lakh rupees. Right? So till now your ATC is filled 1,30,000 plus 1 lakh, 1,30,000. Along with that, you have taken a LIC for you, for which you are paying a premium of 20,000 rupees. Right? So using these components, your ATC bucket is completely filled up. Now you want to save additional amount of taxes. What will be the course of it? How you can save the amount? Now if you invest the money into NPS, exclusively into NPS, that is National Pension Scheme, you can save another 50,000 rupees if you are depositing the money in NPS. So, on the example, 30,000 rupees your EPF, 1 lakh rupees your home loan principal, 20,000 rupees your LIC. On top of that, you are investing, let's say, 40,000 rupees in NPS. In this scenario, you can claim 1,50,000 rupees that consists of your PF, EPF, your principal and your LIC under ATC, and you can claim additional 40,000 rupees that you are investing in NPS under 80 CCD 1B. Right? So if any of you have already exhausted the ATC limit of 1,50,000 rupees, I strongly suggest consider this 80 CCD 1B so that you can save a little bit additional amount of taxes. Moving on, if you are investing through your on your own in NPS, then these are the two avenues available for you. If you are investing into NPS through your employer, then you can save additional 10% of your salary by deduction. Now, how this works is, you have to intimate your employer that I want you to invest on my name into NPS, and they will ask for the amount you are going to invest in NPS. Maximum taxable benefit is 10% of your basic plus DA. Now the key criteria is 10% of your basic plus DA. Most of the non-government organization doesn't provide for dearness allowance. Only they have basic component and some special allowance. This special allowance is not coming for this section purposes of this section. So let's say your monthly basic salary is 20,000 rupees. For the entire year, your basic is coming to 2,40,000 rupees. Now you can instruct your employer to invest 10% of your basic, that is 24,000 rupees, on your behalf in NPS, and in doing so, this 24,000 rupees will be deductible in your hand, and it will be considered for tax computation and tax deduction. Now, for 80 CCD, the maximum amount can be claimed is 10% of your basic. However, there is a monetary limit of 7,50,000 rupees in a year, which is coupled with your EPF and your annuity plan. So let's say during the year, your 10% of basic salary comes to 5 lakh rupees, right? And you are also contributing towards your annuity plan, and that annuity plan is coming to, let's say, around 3 lakh rupees. So 5 lakh rupees is coming from NPS and 3 lakh rupees coming from annuity plan. Now maximum amount of deduction you can claim through this route is 7.5 lakh rupees. That is 3 lakh rupees will be coming from annuity plan, and 4.5 lakh rupees will be coming from your NPS. That is the monetary limit that has been fixed in the budget of 2020. So these are the sections available for you under 80C and related sections. So let's take a look on the other section. One of the most famous section after 80C is your 80D, that is premium paid to keep in force medical insurance policies. Now under 80D, there are two limits. One is for your parents and one is for you. If you have taken a medical insurance policy on your own, and if you are not a senior citizen, then maximum amount you can claim under 80D is 25,000 rupees. If your parents are senior citizen and you have taken a medical insurance policies for them, in that case maximum you can claim is 50,000 rupees. If your parents are not senior citizen, the deduction will fall to 25,000 rupees again. Now, here lies another question. One of my parent is senior citizen, that is more than 60 years. Another is not. Say for example, my father is 61, but my mother is 58. So how will this be happening? What is the maximum amount I can claim? Do this. Any one of your parent who is a senior citizen will give you the maximum benefit of 50,000 rupees. So in this given example, since your father is more than 60 years of age, you can claim the maximum benefit of 50,000 rupees. Sometimes it may so happen, the insurance organization, they are not too keen on insuring the senior citizen people. So they do not issue medical insurance policies for them. In that case, if your senior citizen parents are not covered under any medical insurance policies, you can claim medical expenses for them. The limit is also 50,000 rupees in that case. One thing you should keep in mind in this regard is, if you are covered under any insurance policy which are issued by your employer, in that case, it will be considered that your parents are insured. So let's say there is a group insurance policy going on, for which you are paying a premium through your payroll, and under that group insurance policies, you have mentioned that your parents are going to be covered. In that case, it will be considered that your parents are also insured, and you cannot claim medical expenses for those uninsured parents because they are indeed insured, not through you, but through your employer. So before making a claim for this, keep this thing in mind. Now, moving on, these are a little less known sections under which you can claim the tax deductions. There is this section called ATDD, that is, if your dependent is physically handicapped, then depending on the disability, you are going to get a standard amount as deduction in your tax return. If the disability is more than 40% or but less than 80%, then you are going to get a flat deduction of 75,000 rupees for maintenance of them. If disability is 80% or more, that is severe disability, in that case you can take a deduction of 1,25,000 rupees. Now, for this you may have to submit a certificate issued by the medical practitioner, wherein they are going to give you the disability percentage, the age, the name of the person, the doctor's name and doctor's details, the registration numbers and everything. So on that basis of that certificate, you can claim it. You can submit this thing, you can submit this certificate to your employer, and it can be claimed, or rather it can be considered at the time of computing your taxes and deduction of taxes. Right? Now, there are certain unfortunate events when a person is affected by some severe illness. If your dependent is diagnosed with those serious diseases, then excuse me, 40,000 rupees or the actual amount paid, whichever is lesser, can be deducted in case that person is not a senior citizen. If the person is senior citizen, then 1 lakh rupees or actual amount, whichever is lesser, can be claimed as deduction. Now, what are the diseases that are specified? There is a long list of diseases that are specified. However, on top of my head, I can name a couple of them. One of them is severe motor neuron diseases or Parkinson's disease. One is your malignant cancer. One is AIDS. So anyone suffering from these diseases, you can claim the deduction for that. Now, sometimes it may so happen the assessee himself or herself is suffering from physical disability. Right? Now, if this is the situation, you can claim the benefit for that under a different section, that is 80U. Now, under 80U, you can claim 75,000 rupees. In case it is severe disability, you can claim 1,25,000 rupees. And finally, if you have taken an education loan and you are paying an interest for it, then you can claim the entire amount of interest paid going from the first year of repayment till 8 years. And the good thing is there is no amount bar on this. You can be paying 5 lakh rupees or 10 lakh rupees as education loan interest, and you can claim the entire sum of money as deduction in your tax return. Now, that concludes our session on how to save the taxes and understanding the taxes. Now, we have certain time in your hand and we are going to answer some of the questions you might be having. Okay, Bhaktawar is asking, if medical policies are for a duration more than 1 year, can ATD benefit be spread over the number of years, or benefit will be claimed in the year of payment? Bhaktawar, the amount can be claimed in the year of payment, not through the year, not through 2 years or 3 years. Well, Bhaskar, uh, if more than one bank accounts are held by the senior citizen person, then that person has to file the tax return. If only bank account is present or only branch is present, then the deduction is available, the exemption is available from not filing the tax return. If multiple bank accounts in multiple branches are held, then mandatorily you have to go for filing the tax return. Well, Abhijit, how to claim joint owners? I believe you were talking about the home loan interest and principal. So, if the home loan is in joint name and the house is also in the joint name, you can claim it in the ratio of 50-50. Yes, VPF is considered under 80C. Well, Bhaskar, if the GST paid is more than 12%, you can claim it under LTS. So this includes AC, television, mobile phones, all the electronic goods actually. So if you have purchased those items between 12th of October till 31st of March and the bill is in your name and you have paid through digital mode, then certainly you can claim LTS. Well, Rohit, if your nephew is your dependent, then you can claim it. It has to be mentioned that they must be dependent upon you for their livelihood. So, if that person is dependent upon you, you can claim it. Said, the VPF limit is the PF limit is under 80C, that is 1,50,000 rupees. Well, LTA scheme, this LTA scheme, Prajwal, is only applicable for 2021 financial year. Beyond that, it has not been extended yet. So, if you have not claimed in or rather if you have not made any purchase in 2021, then it will certainly be lapsed. Capital gains is a very broad chapter. I mean, if you are selling of some assets, be it shares or mutual fund units or land building for that matter, or some item of gold, then certainly it becomes taxable. And if it is long term, every capital asset has its duration, and depending on the duration, depending on the nature of asset, your capital gains and your capital gains taxes rate are calculated. Total expenses. Well, there has not been any defined medical expenses. It is common parlance. It is common understanding that medical expenses actually includes of your physical checkup and all those things. And dental expenses should also come under medical expenses. I think it should be coming under medical expenses. Bhaktawar, I believe I have answered that. So the ATD can be claimed at the year of payment. Well, Vinod, if you are covered under medical insurance, then it cannot be claimed any COVID-19 related medical expenses. Also, the government has not come up with any such relaxation in respect of COVID-19 treatment. So I'm sorry, I don't believe you can claim that. Well, Pavan, that is a very important question. Thanks for bringing it up. So, for 80G purposes, if you invest or rather if you donate 1000 rupees, in most of the cases you can claim only 50% of it. So, if you are making a donation, if you are making a donation of 1000 rupees, you can claim only 500 rupees in your tax return as a taxable deduction, not the entire sum of money. However, there are certain charities, certain funds in which if you are donating the money, you can claim the entire sum of money as donation. Say for example, PM funds, right? So PM Care Fund, if you are investing in PM fund, if you are donating in PM fund, PM Cares Fund, you can claim the entire 1000 rupees. However, if you are making a donation towards some charitable organization, then only 50% is allowed. Srirang, okay. EMI for under construction building can be considered. Okay. So the principal component, yes, you can take, fine. The interest component can be claimed only after house is over, house is completed, and you are in possession of that house. So going forward, one option is available for you. So let's say this year the house is under construction, and after 3 years the house will be completed. And after 3 years you will be getting the possession of that house. So what you can do is, or rather what is advisable is, so whatever amount you are paying as interest, make a note of that, keep a track of that. In the year of you getting the possession of the house, take the entire sum that you have accumulated through 3 years and claim one fifth of it, and take claim the interest payment of the year of possession. So in that way you can take the benefit. Medical expenses does not include medical cost. It usually means is your treatment cost. If you are paying doctor's fees or medical procedure fees, those can be claimed as medical expenses. Alright, I believe we are at the end of our session. Thanks for joining us. I hope you have learned something out of this session, and it's been a pleasure addressing you. Stay safe, stay indoors. Bye bye.